they know they need more stimulus. Now, one of the problems for folks like us trading stock markets is we don't know what they mean by big. Is big really big? And the other thing is they haven't announced what they're doing yet. It's very hard for us to give them full credit for doing something when we don't have a good idea of what it is. So one positive move for the stock markets will be a Chinese leadership that makes me change my slide to show us the bigger numbers, to show us broader headlines. Now we come on to the fourth thing we need to see. We need to see investors reposition. Stock markets after the LTRO, stock markets in the middle of Q1, good data. Stock markets, the January effect. We had a good first quarter. And stock market investors do what they do when markets rise. They chase it. So we saw a lot of people buying it in Q1. We saw a lot of investors get involved. We saw massive ETF inflows. One of the great things about being the emerging market strategist of JP Morgan is I kind of keep my finger on the pulse. And I know when salespeople from developed markets call me, or when random derivative salespeople call me and say, hey, what should I buy? Well, maybe the rally's getting a little bit long in the tooth. Maybe the rally's getting a little bit old. And I got a bunch of those calls in February. It kind of tells you all the people who should own this own it, and a bunch of people who shouldn't own it also own it. And now what we're seeing this quarter is the waves of selling. So if you look at the chart on the top, it shows you ETF creation. How many ETF shares were created in the big US emerging market ETFs? And we created about 200 million new ETF shares. They traded around $40, so that's 800 million bucks. And now we've seen that creation process stop, and we're edging into the destruction part. I want to see a lot more ETFs redeemed before I can say all those people who don't really want to own this have now sold out. Now, the chart at the bottom is also really kind of interesting. If you look at the blue line is the equity beta of global macro hedge funds. It tells you, are global macro hedge funds long or short stocks? Now, I hope there are no hedge fund managers in the room. I know we've got some good long-only guys who are going to be up here a little bit later, but I hope there are no hedge fund managers, because I'm going to tell you that these guys were not the smartest guys in the room in the last year. They've been the dumbest guys. They've been maximum long equities when the market peaks, and they've been at their shortest when markets have troughed. They've been the dumbest guys in the room. They're a contrary indicator to me right now. So when you look at where global macro hedge funds are, that's the blue line. They're still net long equities, and they're still selling. I speak to our sales guys. I speak to our trading desk. They are still selling. When they get net short, I'm going to get more positive. And this is a cycle. I've been doing this a long time. I've been an emerging market strategist covering Poland since '96, so I've done this a while. I've seen a few cycles. People buy and then they sell. We're about 75% done with the selling. We have another 25% to go. And then once everybody's sold and everybody's short, there'll be some piece of good news that surprises and everybody will come back in again. And that's really the most important thing to remember in these bear markets, is they are hugely cyclical. Of course, we could get some structural breaks. Greece could exit. We could have another Lehman. Other crazy things might happen. But I can tell you with 100% certainty that in the last 41 years, the world has not ended. Stock markets are cyclical. We're coming to the bottom of a cycle. It will present us with a fabulous buying opportunity when we see the four factors that I've outlined begin to change. The world's not going to end. So that's a good discussion of sort of the short-term issues that we've seen. Now let me just remind everybody about why people like Capital, people like Templeton are on the next panel. People like Capital and people like Templeton are on the next panel are because Western investors know that the future is emerging. The future is in emerging markets. So when you look at the bottom, developed market debt levels are about 3 times what they are in the emerging world. The emerging world has avoided the catastrophic debt dynamics that the developed world has embraced. When you look bottom left, what you can see is a pretty steady rise in Western investors' holding of emerging market equities. Now, the good thing from the cyclical point of view is we're sort of at the bottom of the cycle. This is an upward sloping line. That's what this gray trend line shows you. Developed market guys want more EM exposure. On a cyclical basis, though, we're at a little bit of a trough. So it does give you a sense that there is a long-term future for emerging market equities, and it does give you a sense that there's a long-term future for where we are now, for the Warsaw Stock Exchange. Now, the downside for us poor, humble equity folk, and I know because I hear this a lot from my EM debt colleagues, EM debt has seen significantly more inflows recently than EM equity. When you look at emerging market local currency debt funds, the inflows have been massive, and the yields are incredibly low. I mean, in spite of the sell-off, we're still within about 50 basis points of the all-time low for the JP Morgan GBIEM, Global Government Bond Market Emerging Index. EM local currency yields are incredibly low. Things are cyclical. Investors who have made some money in debt won't be happy anymore with 5.5% yields. They'll seek more risk. They're going to come to me pretty soon. They're going to come to me and they're going to buy some more stock. Now, turning a little bit more locally, I spent a lot of last week meeting with a bunch of the pension funds and a bunch of the mutual funds, and it is rare you find a more depressed group of people. When you look at their equity allocation is only about 33% of their assets. It can be as high as 45. To me, they're extraordinarily underweight. I know there's a peer benchmark. I know that. But there's huge scope for them to raise that allocation. I think as some of these short-term factors, the 4 short-term factors that I talked about change, they will buy more stock. It's a big chunk of money. I mean, it's 240 billion zloty. I mean, that's 50 or 60 billion euros. That's real money. If they move 10% of that into equities, it will move the stock market. It might also allow the Treasury Ministry to get some of the privatizations that they've talked about out the door. The other interesting thing is, in spite of the pension funds being underweight equities, they're owning a greater and greater portion of the Polish stock market. So you see this red line on the chart on the top, it kind of just goes up. That's the percentage of the market cap held by pension funds. It's at a record high. Foreign investors have been selling, pension funds essentially continue to buy in. The interesting thing is that if you look back to when it was almost this high before, actually, a better one to look at is the gray line on the bottom right. In December 2003, pension funds held about 12% of the WIG. That was sort of the height of what I think was the popular pension fund story in the stock market. If you look at what happened in 2004, the WSE, the Warsaw Stock Exchange, this very building, the Warsaw Stock Exchange had more IPOs than any other market, than any other stock market in continental Europe. More than anybody else. It was a big deal. Huge amount of issuance, huge amount of demand from the locals. What we also saw was stocks cross-listing into Poland. So 2004, MOL, one of the 4 biggest stocks in Hungary, listed into Warsaw. And over time, we've seen more companies doing that. It's essentially the Warsaw Stock Exchange becoming the regional hub. You know, when people want to trade stocks in this part of the world, when they want to trade stocks in Central and Eastern Europe, they come here. The biggest reason they come here is because of that 240 billion zloty in AUM. There's a group of investors that buy stuff here. That's what they do for a living. They don't seem to enjoy themselves while doing it, but that's what they do for a living. And that's why people will continue to come here to invest. Now, let me also just throw a few bar charts and a few numbers and wave my arms a little bit more before I send you all off for coffee. In terms of being a great place to trade, more stuff gets traded here than anywhere else. If you look at this bar chart on the top, and I looked 2007, you know, back in the day, and also 2011, Poland has 37 stocks that trade more than $1 million a day. Hungary and Czech combined have 13. And you can actually trade a fair number of those 13 in Warsaw. Romania, Bulgaria, very, very few. You look stock by stock in terms of volume. You know, Polish stocks, in terms of the median stock in the WIG 20, trades more than the median stock in Hungary or Czech. Down a bunch since 2007, and the brokers out there will remember the glory days of the past. But then you look at the declines in Hungary and in Czech, much more severe. People are coming here to trade. And then you look at the average volumes in Romania and Bulgaria, and you just realize how tough it is in those markets. The volumes have dried up. And really the reason is, I think, that people come here to trade because of that 240 billion zloty in AUM for the pension funds. Anyway, if you guys leave this presentation thinking about one thing, I really want you to think about four things. The four things that are going to change to make these stock markets go up. It's about the euro crisis. It's about growth in the EU and the US. It's about the resumption of Chinese growth. And it's about investors' positioning. And with that, I will send you off to coffee, and I will be around to take questions afterward. Thank you very much.
Thank you. Many thanks for your presentation, very optimistic one. Drodzy Państwo, tak